All right. Good
Hello,
evening,
anybody?
everyone. Please turn off your
Good
mic.
evening, Chief. Pleasant.
All right. Good evening, everyone. We'll be talking about complex liquidity. I think during the course of our last class, we discussed about basic liquidity. We talk about external liquidity, the types of external liquidity, which are the buy side and sell side liquidity. Now, in complex liquidity, we're talking about the various form of external liquidity. Now, remember, during the course of our last class, we discussed about the types of external liquidity. All right, first that we have the buy side and the sell side liquidity. Now, today we're talking about the forms of those of external liquidity. All right. Now, when I say form, basically, how does this sell side and buy side liquidity usually used to appear in the charts? Because it will not just appear as just a we don't even know what liquidity is, like how it appears in the chart and all that. So there are different ways at which the buy side and the sell side liquidity do present themselves in the market. Some of you are already familiar with this, some being and we'll be focusing on four. All right, we're focusing on four. The first one is the inducement liquidity. The second one is the trend line liquidity. The third one is the range liquidity. And the fourth one, fourth but not the least, is the one we're just going to take a brief scroll and look into it, which is the um excuse me, the engineering liquidity. All right. So with that said, let's get started. We'll be starting with the trend line liquidity first of all. With the inducement liquidity. First of all, what is inducement? Inducement normally, like in our normal layman's terms, to induce simply means that to like more or less to like make someone do something they didn't want to do before. All right. So in the market, inducement is probably making a trader, please excuse me, making a trader to take decisions he is not supposed to take. All right, that is inducement. So, and in this tool is used by the smart money guys to make retail traders to take the other way just because they want to do what they want to fill in their order. Take for instance, if market was supposed to buy, now we all know that market is going to buy, but because of a move made by the smart money guys, your retail traders with them is thinking that okay, market is not going to buy anymore. Market is going to do what? It's going to sell. And for that reason, they will start looking for shorts. So with that, we can then say that the smart money guys have induced your retail traders to start looking for short position, whereas it is not yet time, whereas markets want to continue the long it was on before. All right. Now, the reason why many people that don't trade SMC or whose concept is not relating with SMC, if you check most times, they are the ones that usually end up with low win rates. Why? Because majority of their trades we end up in losses of a thing and another. We have to go the other way. Why? Because they are most, let me just say in plain, they are the ones who most likely tend to use as liquidity major times. All right. So with that being said, let's talk about the inducement properly. That means as the inducement liquidity. Now, inducement is more or less a fake move made by the smart money guys to do what? To induce buyers and sellers, or rather, to entrap early buyers and sellers. That is inducement. All right, it is a fake move made by your smart money guys to trap early buyers and early sellers. All right, so now remember what this liquidity, why we're looking out for this liquidity, so that we will not be the liquidity. Because we look out for liquidity because we know that we are trading the smart money concept. We want to trade the smart money, and the smart money won't enter the market unless there are a lot of orders to fill in their trade. So you can't be using smart money concept without an idea of liquidity concept. You need to understand where liquidity is so that you will know exactly where your smart money guys will be waiting for, where your smart money guys will be doing what, will be interested in. Liquidity is the most important thing you have to put your eyes out for. Like that is one of the most important things you want to be looking out for in the market, liquidity. Because once you can get where that liquidity is resting, you just need to just take your trade and let that trade fly. Because you already know where liquidity is in the market itself. All right. So with that said, the first thing we're looking into, that's the inducement liquidity. Now, the inducement liquidity, like I said, is a fake move in the market made by your smart money guys to do what? To trap early buyers and sellers. And to identify it, it is the first pullback after a break of structure or a market structure shift. What do I mean? Take for instance, we have sorry about that. Take for instance, we have now what do we have here? We now have our market structure shift at this particular level. Now, your inducement is going to be the first pullback. Pullback simply means that after an impulsive move, a correction move, all right, that is a pullback, all right. So the first pullback after a market structure shift, this will then be your inducement. But your inducement is not confirmed until you give out one of these three criteria, which is you should take out at least 50% or 70% of the move. This is the pullback, all right? This is the pullback. So you should take out at least 70% of this pullback. That means that from here to this particular level that price wants to reverse from now, you should take out at least 70% of this little pullback that he made. So 70% will be around here, 50% or 70%, but perhaps I'll just make use of the 70%. 70% tend to hold more better than the 50%. The 50%, most of the time, just consider it like, okay, this market does not have liquidity. So this is what you want to be looking at for 70% first of all right, of that particular move. You should take out at least 70% of the pullback. That is what validates your inducement, the first criteria that validates your inducement. The second one is that it should give you at least double top or double bottom in the case of a downtrend. All right. So it should give you at least double top. Now, the third one is that it should give you what? A break of structure. That means a little break of structure, perhaps in lower time frame, or excuse me. So it should give you what? A break of structure. That is the third criteria. All right. So three things. That's what you want to be looking out for. If any of these three is present, then your inducement is valid. The validation of an inducement is that the first one, it should take out at least 70% of the pullback, or it should give you a double top, or it should give you a break of structure. Now, after that, your inducement is now valid to be called a liquidity. That means an inducement liquidity. It's now that you now have a what? An inducement liquidity. And then you can then look for your whatever your points of interest, which your market mechanics around here. Why? Because remember the rules I gave to you guys when we're dealing with external liquidity. We said that price takeouts, like advanced market structure, we said that price takeouts what? One liquidity and take out the other liquidity. Like one external liquidity, then take out the other external liquidity. Then we also said that price take out external liquidity, then tap into internal liquidity before taking out the other external liquidity. So right now, price is going to the upside after taking out the previous side. It means that you're taking out buy side liquidity already. We are not taking about that one. Right? This is an uptrend. We're not taking about that buy side liquidity yet. We want to look out for the sell side liquidity that price need to take. the sell side liquidity that your smart money guys are what they are interested in. That is the liquidity you want to look out for. Your smart money guys will not be interested in buy side liquidity because we all know that market wants to do what? Want to fly. That's why it's good. That's why we took market structure first, so that we be able to understand or identify the trend of the market. Once you identify the trend of the market, what you just need then is to look out for liquidity. That's all. Then after looking out for liquidity, before you look out for your points of interest to take your trade from. So always look out for that particular liquidity. That is the most important thing. So after you identify your trend of the market, then after the break of structure, the market structure shift, you do what? You look out for your liquidity. Because that will be the liquidity that your smart money guys will be looking at for. That's where money is resting. So they have to push price to come to this particular place, come and take off this place so that they were able to do what? To place their trade. If this was to be, let me say, Great Britain pounds and the Japanese yen. Now, if this is an uptrend, market is moving up, that means that GBP will be gaining. For GBP to gain, that means money will be entering GBP. So take, for instance, one bank in one big bank in Japan have a lot of Japanese yen and they want to buy Great Britain pounds. Now, what will this bank do? For them to buy, they have to exchange their normal Japanese yen for Great Britain pounds. But in the financial market, there's not enough Great Britain pounds to fill in their order. Perhaps they want to buy 20 million Great Britain pounds. So there won't be enough orders to fill in, like there won't be enough sell orders for them to actually buy. That means when I say sell orders, there won't be a lot of people saying that they want to sell their Great Britain pounds. So you guys are getting my point. So because there won't be a lot of people that want to sell Great Britain pounds, what will then happen again is that, okay, they will have to look for a way to like manipulate the market. That this manipulation of markets, inducement and all that, we have a whole this on its own when it comes to advance. That will be among my private community people. Or you can go and learn it from YouTube and all that. But regardless, for for the manipulation of a thing, like they look for a way to manipulate the market so that those people that are buying, those people that have the Great Britain pounds, will most likely want to sell their Great Britain pounds. And when they sell, so that means that there will not be a lot of Great Britain pounds in the finance market for this Bank of Japan to actually buy their 20 million, because right now it's not up to 20 million. That's why they are unable to buy. So they have to manipulate the market to make people feel like, okay, Great Britain pounds is going to do what? Is going to fall. So they will start selling. And when they start selling, thereby pushing the market down until it gets to the particular level that your smart money guys will most likely say, okay, if market take out this particular place, the money that will be living there will be enough to fill in their orders. That will be all these levels that we cannot see in the chart like this. Because for market to actually form this low, to actually reverse from here, so it means that a lot of people bought at this particular level, this place here. So if market take out this place, so it means that a lot of buyers have done what? Have sold off. That's exactly what it means. And for a lot of buyers to sell off, there'll be a lot of sell orders in the market. And when there are a lot of sell orders in the market, your smart money guys cannot fill in their what? Their position, their trade of a thing. And when they fill in their trade, what will happen next will be an impulsive move to the what? To the upside. This is the old theory about advanced SMC. So it's pretty simple. Have your sell-side liquidity beforehand, which in this case, it is the inducement, all right? So this is the inducement, and we take out at least, remember the criteria, 70% of this previous move, the pullback, or give you a double top, or give you a break of structure. In this case, this is a break of structure, all right? And then what happened? Price came back, took out the sell-side liquidity, tapped into an internal liquidity, which is any market mechanics around this particular level, and then did what? Came and take out buy side liquidity. So as you can see, the market still did what? The market still bought, but people have sold off around this particular level before market started buying. People that were induced have done what? They have sold off. But we that make use of the smart money concept, we already know that okay, this is what is going to happen. And then we look for what? The point of interest that we use to place our trade after all those sweep of liquidity of 18 and all that. That's why we as smart money traders, SMC traders, we do what? We look out for liquidity first of all before entry, before looking out for our point of interest. So remember, the first thing is the trend, the market structure. Then after which, look out for your set side liquidity in the case of an uptrend, which can be anyone. But in this case, in the case of an inducement, which is the first pullback after a market structure shift or a break of structure. All right. And after that market structure, a break of structure, the first pullback after it. Now this pullback should take out at least 70% or give you a double top or give you a break of structure. Those are the three things that validate an inducement. Then before coming back to take out that particular inducement and tap into the point of interest to continue the move. And your inducement is denoted as IDM. You can be using it until you fully master it. All right. So this is you can identify inducements in the market. All right. Or rather, this is what inducement is actually all about. So we I have to go identify some of them, and this I will be using trade that I've took already to like explain it much more better. I think that will be far more better than going to look for it again. So I think this is GJ. I usually take a lot of trading GJ. So let's see what happened here. I think this was recently, that was Friday, November 25th. Now, what happened? This was a break of structure, just like I told you guys. The break of structure. Then after which, market did what? Market gave us this inducement. You can see the first pullback after the break of structure. Then what happened? The inducement gave us a break of structure as well. After giving us that break of structure, market pulled back and took out that inducement. Then my point of interest was around here, which I entered the market for a what? For a long. This was a 1:17. If you have used your $10 to, if you have raised $10 in this particular trade, we get $150 back from the market. So that's for this first position of a 10. And let's go back to this second one. The same thing as well, but that was in the lower time frame. I use the 5 minute time frame, but because of time and all that, I have to use the I have to use a 15 minute time frame to actually explain it. So over here, what happened? You can see our break of structure at this particular level, which is much more visible in the 5 minute time frame. And after which, you can see our points of interest, our liquidity first of all, which is our inducement, the first pullback after a market, after your break of structure, your market structure shift. Then what happened? You can see my other block here. On my case, it's an advanced distance. So it was at this level that I took my trade from. And that was a 1:8. And your $50 for that give you $400. So that was it. And my target was here. Normally, your target should be around here. But because of this particular move, I know for sure that market is going to come and clear off this high that price created, because that was supposed to be my main TP for this particular trade, which would have been a 1:43. So that means that your this thing, your $10 is supposed to be $430. So, and if it was $50 you were risking for that particular trade, you should know how much you be getting. That would be around $2,000 for this particular setup. So that's for that. This one will be my main TP. That was why I kept on taking long until I saw that I think there was something here that actually made me to stop. I paused for a bit, knowing that price is coming to take out this liquidity. It was too early for market to use this place to continue to the upside. So since market failed to provide liquidity before reacting to this particular place, I knew that it's going to take out this place as what? As liquidity. And that was why I didn't enter the market until market took out, clear of this liquidity, clear of this side liquidity, and then what happened? Change a little bit and a breakout. Then after which, moving on, there was another setup around here. So we have our breakout structure here. Now you can see your pullback over here after the break of structure of a 10, right? Then after which market pulled up to the upside and came back, took out the inducement, but not yet reacted to my point of interest yet. My point of interest is a breaker block, which was in conjunction with another block here. But I think I used the breaker block, although I used my advance. So when we go over to advanced market structure, you will get to understand that one perfectly fine. So don't ask any question regarding my point of interest for now. They were all advanced. That's why you can see that I can cash some good risk to reward trade of it and all that. So, and my TP was the point of the new high that price created. With that, I got a 1:20 trade. I was expecting a retracement after using this place. You can see our break of structure here. Then this one will be the liquidity, but price did not come back until push on, push on, push on. Okay, I was expecting something like that to happen here, but because price did not come back around here, this side was still on balance. That was why price have to fall back massively to this particular level, using this place as its liquidity. And see the break of structure over here that it used. Although this is not a break of structure, but in a 5 minute time frame, most likely see your close above. And for the points of interest, I think price most likely use this advanced breaker block here. So you can see from here, push to the upside. And I think make sure to clear off this particular spot. I think around there I caught a trade. Okay, that was on EJ. Yeah, I caught a trade on EJ around there, which I will explain after this one. So after which market came to this particular place and gave us this stuff here. Now what happened here? Simply break of structure, liquidity. Then I look for my points of interest around here as I got this trade on. That was a 1:12. Then this next market again. Now this was on a lower time. This was on a 5 minute time frame. This was the liquidity. Market broke this particular place in 5 minute time frame. So I use the liquidity here. Mark as my points of interest. As you can see, it's in conjunction with the 15 minutes rejection block of a 10. So price took it out and pushed to the upside. So this is how you can use inducement. If you check very well, it's inducement liquidity that I'll be using majority of the time. It's inducement liquidity. When this one as well is on the 5 minute time frame. I was dealing with the lower time frame, so that's why you can see that I'm able to like it's not visible in a 15 minute time frame. And the same thing again, I'm also expecting it to happen here. My break of structure, then the liquidity. So I'm expecting price to do what? So come and take out this liquidity and tap into this breakout block here for this particular trade. That was a 1:21. Okay, let me show you that of the EJ and then we can go on to talk about um this thing. Okay, now this was set up on EJ. This is my current setup. Like I told you guys on this thing. I've already closed this setup in particular. I closed it. It was around here now. But I say that I've closed this set. I'm closing this setup because I saw the this thing. Whatever that is happening. GJ failed to clear off liquidity. And so GJ failed to clear off liquidity. So it means that JPY is about to become very weak. That was why I closed. Okay, this is what I was talking about. So over here, we have our break of structure, we have our pullback, then price took it out, tap into this other block here, and push to the upside. I think that was a 1:10 sweet trade. So these are some few ones we can, okay. All right, this one, I'll use this one for range liquidity example, but that's for that. Then this trade that I took, that was all this trade since November 18th to a month, almost a month later, well, after is the next month, December, whatever. And inside it, I call this short position. This was a 1:11, while this one was a 1:22. This was the last long I took before price got to its destination. As for the points of interest, the points of exit I took this place from, well, it's a long story. I think I got this particular exit point from 1990 something. Back, like I have to go and do deep this thing before I was able to get that point of exit of 10. All right, that's for that. Now let's talk about engineering liquidity. Now, most of the times, markets won't be able to like provide liquidity before coming back to like use that particular low. Take for instance, okay, we have this market. Let me use the case of a market structure shift. Sorry. So let me say we have this. Sorry about that. Let me say we have this. Oh. Now we have our break of structure over here, right? Now, first and foremost, I'm just showing this in liquidity so that you can be able to explain cases that markets will use a point of interest without providing a liquidity. So in such case, engineering liquidity is when, just like the name goes, engineer. So engineer specifically means that to create something, to bring something into a system when you see that that thing was not supposed to be, like, to program something, stuff like that of a term. So more or less is your smart money guys trying to engineer liquidity so that they will be able to like induce your people, manipulate the market a little bit so they are this so they can be able to place their trade. All right, that's the essence of engineering liquidity. Now your smart money guys cannot wait. They have orders sitting at let me say 126.18. They have their orders sitting here, and there won't be enough liquidity to actually fill in those their orders. There won't be a lot of people trying to sell around this particular level. So because of that, they have to induce the market before the market comes to this particular level. All right, market is already closing at that particular level. So what will they do? They will induce the market by pushing the market upward a little bit so that many people will then think that market wants to reverse from here now. And then what will happen next is that come down and take them out. Take everyone out. Everyone that did your early buyers and sellers that were unable to wait for market to get to their point of interest here. Take them out and then come to use this particular order block to do what? So the point of interest there to actually, go with the market. So in this case, this will be our sell liquidity in the form of engineering liquidity. So this is your engineering liquidity, all right? Please and please, it looks so much like inducement, but it's not. It looks like inducement with 70%, but it's not actually inducement. Inducement is something like this. You can see just after the break of structure, then a pullback, take out 70% before actually coming down. This is the difference between an inducement of 70% and engineering liquidity. But most of the times, the both of them actually look similar, all right? But they are not, please and please. Engineering liquidity don't used to have the kind of force that inducements have because it's just a little, manipulation move of a thing and film. So this is the reason why markets will use some market mechanics without providing liquidity, all right? That said, that's engineering liquidity for you. Now let me see whether I've used any engineering liquidity recently. Yeah, I've used one recently. Wait, okay, this mine, this thing. I'm able to go back here. If not, there was one engineering liquidity that I used in this particular place. Okay, this thing is. Let's go to EG, GG. You see this one? This is a typical example of engineering liquidity, right? If we're going to use this as my point of interest with that rejection block there, then this will be the engineering liquidity that markets use. Why? Because price did not provide a better liquidity for the market. Price did not provide a strong liquidity here. So it was a decrease of the lower time frame. So markets have to do what? Your spam guys have to engineer liquidity into the market. As you can see, just watch at the this thing, watch about think something like this. Just like what I explained to you guys just now. Oh God. Sorry about that. I have to redraw this thing again. What is happening? Why is this thing? So as you can see, just like I drew the other time on EJ. So market just use this particular place as its liquidity instead to actually push to the upside. So this is the case of an engineering liquidity. Even at this particular level, for market to use this point of interest here, it was the engineering liquidity. Where was it? The TP of this particular trade was the engineering liquidity. All right, this one over here. So going with this, okay, let me use a clear GJ chart. UAP. So you can see it, market pushed down, came back up, engineer liquidity, and then took out the liquidity and then pushed down again. So you can see that markets use engineering liquidity in this case in particular. This is you can identify engineering liquidity in the market, but just so you know, if you are following me, I don't use engineering liquidity. All right, I use engineering liquidity. I use major times inducement. Inducement is key when it comes to liquidity of a thing. So I most likely use inducement liquidity. I only use engineering liquidity. But like I said, I only use it to confirm that okay, the reason why price use this points of interest is because of this liquidity, and because of that, there is a possibility that price will not come down to my points of interest anymore. So I know that okay, this is most likely a miss entry rather than waiting all day and then price will skyrocket and fear. I think we noticed that in the other GG. What happened? Because I knew that price have used underlying liquidity. That was the reason why I was able to like pick up, okay, go with the next move. If not, I'll be waiting for price to come and okay, take out this liquidity and use this other block here to actually push market further down. But because I knew exactly what was happening, so I knew that okay, market is no longer coming back again for the time being until it take out this place particular. That was why I took this particular trade. And that was a 1:11. So if I have not been that vigilant, I would have missed that 1:11 trade already. So that's all for today's class, everyone. Do you have any question regarding what we did today? Anyone have any question? Unmute your mic. We are done.
Yes, you get question. In the manga you're inducement, you said the first break of structure, but then if you continue with that, your thing, because you say you get another break of structure where you don't really count, it can be like two break of structure before you're saying. So,
Yes, I think we did
what does that
liquidity. We did liquidity today, so I'm not expecting a question regarding break of structure.
do? So, not the break of structure like that in inducement. Like if you just keep go down this, like people you like that.
Which one was that? Was it the last this thing, the last settle that I took?
No, in GPP, GPY.
Are you talking about this one? Are you talking about this one?
I'm not sure. Yeah, this one. There was a trick you click, constituent. Like let's click it, you're taking that trade. Not this place, back. Like back. Like if you can go back. No, not here, like back.
Really back again.
Yes, this one. Is it this one? No, not this one. Continue going back. There's another one that is still. Yes.
No? Is it here? Are you there? Okay. I think
I
it
have
was
a
clear.
question. I have a question.
You're gone.
So in the case that like we have two blocks, maybe like one other block, the other one breaker block, and price first after the market structure shifts, price give us an inducement or okay, let me just say any inducement share, then tap
Okay.
into the
The question you're about to ask is regarding market mechanics. Is it regarding liquidity or market mechanics?
liquidity, the engineering liquidity.
Okay, ask, go on.
So like if price tap like give us inducement, tap into the breaker block first, no breaker block before the other block. Tap into breaker block first, but the no is still to break structure. We can price use that breaker block to serve as engineering liquidity for the other block. Then you can use
No?
to structure.
Yeah.
Okay, sir.
Each and every move in the market, we have to react from a market mechanics. So price to create that engineering liquidity, you reacted from the breaker block. That's just it. Most of the
Okay.
times, such thing happen like that in the market. Most times, where price will most likely use the breaker block as to engineering liquidity reaction. Then take out the engineering liquidity and use the other block instead. So it happen like that in the market most times. Anyone have any other question? That's answer your question, Abe.
Yes, sir.
All right. I don't have any other question regarding today's class. All right then. Also, if you have any other question, please just send to our group chat. So, also no question. That will be the end for today's class. Good night, everyone.